what is the relationship or similarity between effective interest rate, internal rate of return, and YTM, that is yield to maturity. We understand IRR very well. We understand YTM also very well. Let us get clarity about the effective interest rate. What is effective interest rate? So let's say I make an investment of 10 lakh of rupees with State Bank of India for a duration of 10 years, where State Bank of India is offering me a rate of interest of 7% with a condition that every year this interest will be uh, credited to my account, and on this interest also State Bank of India will pay me interest. So it means what? It means on this investment of 10 lakh of rupees that I am making with the State Bank of India for next 10 years, on which State Bank of India is going to give me interest at the rate of 7%. Now, if this rate of interest was to be normal rate of interest, then how much money I would have received at the end of 10th year, and that is 7% of 10 lakhs, and that comes to 70,000. 70,000 interest I would receive every year if the rate of interest was to be normal. So 70,000 of interest for 1 year, that means 7 lakhs interest for 10 years, and plus the principal of 10 lakh, what I would receive at the end of 10th year, because of the rate of interest being the normal rate of interest, I will receive from the State Bank of India 17 lakh of rupees. Now, if the money that I am putting with the State Bank of India was to be within a condition that State Bank of India will not only pay me interest on this 10 lakh rupees that I am keeping with the bank, but it will also pay me interest every year on the interest that would have accrued every year and year after year on the principal that I have kept with the bank. Then if you calculate, you would realize that what you will get at the end of 10th year, it is not going to be 17 lakh of rupees, that is 10 lakh of principal and 7 lakh of interest. It is quite possible that what you would receive at the end of 10th year from the bank is going to be 18 lakh of rupees. That means 10 lakh rupees on account of principal and 8 lakh of rupees on account of the interest. And if you break this interest, you would realize that 7 lakh of interest is nominal interest, and 1 lakh interest that you have got is on account of the interest on interest. So therefore, though your nominal rate of interest is 7%, but what you have got by way of interest is 8 lakh. So therefore, your effective rate of interest comes out to be 8%, and that is your effective interest rate. Now, this concept that I have discussed with you in the context of EIR, remember, this is also built into the calculation of IRR and also in case of YTM. So when you calculate the internal rate of return using Excel sheet or otherwise, so when you are calculating the IRR, the system is automatically built into it, and it is automatically assuming that whatever the cash flows that you are getting, those cash flows are getting reinvested, and on those reinvestment also you are getting a return, and that is how you arrive at the figure of IRR, and that is how you arrive at the figure of YTM, and that is how you arrive at the figure of EIR also. So that is the concept of effective interest rate and also YTM and IRR. As a matter of fact, it is the beauty of effective interest rate that with the help of effective interest rate, you are also able to explain as to how does the YTM works, how does the IRR works, which otherwise difficult for people to comprehend. I hope that answers your doubt.
In fact, I was finding it difficult to understand this concept.
हाँ.
When you read the definition and all, वो time में समझ आता है, but
Hmm.
I think you have beautifully put it with an example and linked it with IRR and YTM.
Yeah.
That, yeah.
Perfect. Perfect. Perfect.